Hello and welcome to my channel, The Quality Investor. This is a quick introduction to me and what this channel is all about. This is a channel for people that love investing, for people that love picking stocks and the satisfaction of finding a winner. I've been dabbling in the stock market now for about 18 years. From the moment I deposited a part of my first paycheck into that company 401k, I became an investor. For the first few years though, I bought strictly passive index funds. About 75% was in an S&P 500 fund and large cap growth and value funds, and about 25% was in small and mid cap funds. It was really nothing special, and there were some years I beat the market and some years that I didn't beat the market. But in all honesty, I never really paid attention to it. All my investing was done in a 401k and an IRA. I didn't even have a taxable account, and I certainly had no investment philosophy. And because of that, I made a lot of mistakes. So this video is not only a welcome to the new viewers considering subscribing, but to all my viewers on what to expect as a subscriber of The Quality Investor. I really enjoy this community of quality investors. It has been so supportive, constructive, and you spark some great discussions and great ideas for content. I feel wonderful when I do this, and I want that passion to shine through to all of you. So if you're considering subscribing, this is the community you will be joining. A group that's passionate about investing, supportive, and shares new ideas. I believe in the power of the American stock market to create wealth. And I want as many people as possible out there to share in the greatest wealth engine ever known in this world, the American economy. And the simplest way to get a piece of that is through the stock market. So I want all of you to share in this journey with me to grow your own wealth, discuss quality businesses, and be part of a community that is optimistic and driven to winning in the stock market. And I want to continue learning every day from books, great investors, and from you, those a part of this quality investor community. Something I've come to learn over the years is that building wealth isn't so much about picking the right investments as it is about avoiding costly mistakes, especially dumb mistakes. So my first promise is to help all of those willing to become great investors to avoid some of the mistakes that I made along the way. Next, I want to stress the importance of having an investment philosophy. Not having an investment philosophy is one of the biggest mistakes there is. It took me years to develop my own philosophy, but it really doesn't need to take that long. And the last big promise I'm providing to you is to provide in-depth, honest, and high quality analysis of the best businesses out there to add to your own portfolio. It's important to take some time to crystallize your own investment philosophy. What do you want from investing? Are you close to retirement? Are you more concerned with growth or value? What is even your risk tolerance? These are just some of the questions to start asking to formulate your own investment philosophy. To help with this, start with reading some books and following some super investors that have a proven track record of success. Learning the habits that made others successful will certainly help make you successful. Also, what do you know now? What sort of industry do you already work in? Where do you go around town and it's always busy, always doing tons of business? Invest in what you know. If you work in the insurance industry, for example, you have way more knowledge about that than the average person out there. Is there a restaurant in your city that always has a line out the door? What are some of your interests? If you're always buying a certain product from a company, maybe you should start looking into that company a little bit more. What are they doing to earn your money? It is my contention that a coherent and thoughtful investment philosophy is the best deterrent of mistakes. Mistakes are largely driven by emotion, and there's an inverse relationship between mistakes and an investment philosophy. Mistakes decrease the more you develop a defined and solid framework. Remove as much emotion as possible. I've made many mistakes, from buying stocks that were the hottest thing out there to funds that I had zero clue about, all because I wanted to make quick money. But it all ended up with me just losing money and feeling very stressed out about it. A framework prevents that type of irrational decision making. Every decision that you make will be within a framework that is personalized to you. When you see a stock, it will run through your own criteria to see if it's worth owning for you. That way, outside noise won't pull you in all these directions that you don't want to go. Noise like the news, hot tips, a market that might be falling, and even friends and family and YouTubers like me. Remember, nobody cares more about your money than you. And buying stocks on a whim without any reason for buying will just cost you a lot of money. The first rule of investing is don't lose money. As an example, I'll give a basic rundown of my own philosophy. When I buy a stock, my intention is to hold it for a very long time. Therefore, I am careful about what I add to my portfolio. I will only sell if the underlying thesis, my reason for buying, is altered in a materially negative way. But only I can decide that based on my own criteria. In each stock, it has its own set of criteria. Next, I ask some basic questions as I consider a new stock. I'll run through those questions in a second, but this framework is developed to match my own temperament and personal goals. So this works for me, but you'll have to come up with your own. This is just to show what a framework looks like, not something to copy. The first question is, how wide is the economic moat? An example for my own portfolio is Costco, ticker COST. They are the undisputed king of wholesale. I've made a few videos about Costco before that describes their incredible business model. Next, is the business operating in an industry with high future growth prospects? An example here is Applied Materials, ticker AMAT, a semiconductor equipment provider in an industry poised for huge growth as we become more and more digital. The next question is, does the business generate predictable revenue and run capital light? Businesses high in predictability and light in assets mean more free cash flow, which is the money that goes into the pockets of shareholders. My example here is MSCI. They collect asset fees in all their funds, as well as collecting fees from other funds that use MSCI indices as their benchmark. Next, does the business have strong management? An example here is Ulta Beauty, ticker ULTA. As measured by return on capital, it is consistently over 25%, which is one of the best in retail. And over the last 10 years, they've grown margins, earnings, and free cash flow far faster than the broader market. Next, is the business a leader in its field? An example here is Adobe, ticker ADBE. Adobe is actually my latest purchase, and they're widely considered the leader and standard in design software. And finally, does the business reward shareholders? As an example, look at Lowe's, ticker LOW. For the last 10 years, Lowe's dividend has a 20% compound annual growth rate, and they buy back 5.8% of their shares annually. These are just some examples of the great businesses that I own in my own portfolio. Through these questions, it helps me narrow down to a handful of quality businesses from which I choose. And by focusing only on that quality, I have very little stress about my portfolio. In every video I do, it does relate to some aspect of my investment philosophy, and every video I do in the future will also do the same. I know that simply holding great businesses will be the catalyst for the growth in my portfolio. I believe less is more. I don't trade, I don't time the market, and operating within a framework prevents those emotional decisions. This final point though, this is what will really drive above average returns. Is the business trading significantly below their intrinsic value? What is intrinsic value? I did a video on it a while ago, but in the most basic sense, it takes all projected free cash flows and discounts it back to today. You can check that video out for a much more in-depth explanation. But as a real-life example, I did a valuation on Adobe back in mid-December. At that time, Adobe was a bit too expensive for me. They were trading at about $600, well above my acceptable margin of safety. When I did that video, I wanted Adobe to fall below about $550 for me to start buying. Well, a couple of weeks ago, Adobe did just that. It fell into the 540s and I started buying, and I plan on buying up until about $575 a share. But following my framework, it gave me the patience and confidence to wait for a great business like Adobe to fall into my own acceptable price range. So to sum up my philosophy, I buy quality businesses. I buy them when they fall below my acceptable margin of safety, and I simply hold on to them for as long as they possess the qualities that prompted me to buy in the first place. I will continue to deliver on my promise to help avoid mistakes, help develop an investment philosophy, and to provide in-depth and honest investment analysis. I want to thank all of my subscribers for your support. And for those that are new, come join me and this community so we can all help build high quality wealth together. Oh, and remember to like and share this video. Also hit that notification bell so you can know right away when I post more stock analysis content. Thank you and happy investing.